Hey everyone, welcome back to the channel. Today I want to talk about one of the better performing ETFs in my portfolio, and that is CHPY. Let's call it CHPY. The YieldMax Semiconductor Portfolio Option Income ETF. And yes, it is from YieldMax. Now, I'll be honest, when you see a fund advertising a 45% distribution rate, your brain immediately goes, okay, what's the catch? But here's the interesting part. CHPY has actually been doing quite well for me. So in this video, I'm going to do something very simple and very transparent. First, I'll show you my real numbers, what I've earned, what's the capital gain, what's the dividends that I received. Then we'll go deep into what this fund actually does, how it generates income, the expense ratio, the risk, and whether I'm planning to add more. And as always, this is not financial advice. Everything I say here is for entertainment and educational purposes. Please do your own research and invest based on your risk tolerance. Alright, let's start with the numbers. So here's my position in CHPY. I currently own 113 shares. My cost basis is about $6,098. So the current value is around $6,887. So on capital alone, I'm up roughly $788. But here's the more interesting part. I already received $854 in dividends, which means my total profit is about $1,643. That's a total return of about 26 to 27%, and my internal rate of return is over 39%. Now, pause for a moment. This is exactly why these high-yield ETFs are so tempting. The income starts flowing quickly, and psychologically, when you see dividends coming in weekly, it feels good. It feels productive. It feels like your money is working, right? But before we get carried away, we need to understand what this fund is actually doing, because yield without understanding is dangerous. So what exactly is CHPY? Well, it stands for YieldMax Semiconductor Portfolio Option Income ETF. That's a really long name, but let's simplify it. It is an actively managed ETF that invests in semiconductor companies, sell options on those holdings, distribute income weekly. Its primary objective is current income. Capital appreciation is secondary. So this is not a pure growth ETF like SOXX. It is not just buy semiconductors and let it run. It is semiconductors plus options overlay. That overlay is where the yield comes from. So how the strategy works. The fund holds 15 to 30 semiconductor stocks. If you look at the top holdings, you will see names like Nvidia, Broadcom, Lam Research, ASML, TSM, Micron, and KLA. So it's basically a concentrated semiconductor portfolio. Now here's the key. On top of holding these stocks, the fund sells call options. What does that mean? It means they collect option premium in exchange for capping some upside. So if Nvidia shoots up 30% in a straight line, CHPY may not capture all of that, but in return, they collect steady option income, and that's what funds the weekly distributions. Sounds attractive, right? Yes, but there's a trade-off. Upside is capped, downside is not protected. If semiconductors drop hard, CHPY will drop too. The option premium might cushion it slightly, but it does not eliminate risk. Now let's talk about that 45% yield. This is where things get interesting. The distribution rate is around 45%. That's huge. But if you look closer, the 30-day SEC yield is 0%, and the most recent distribution was 100% return of capital. Now this part is important. Return of capital does not automatically means something bad. In options-based ETF, return of capital can simply reflect how option premiums are classified. But what it does mean is this. The yield is not traditional earnings. It is engineered income from options activity. And then when you see another number payout ratio above 1,300%, that should immediately tell you this is not a normal dividend fund. This is not Coca-Cola paying dividends from profits. This is a high yield options machine. So when you buy CHPY, you're not buying a 45% business yield. You're buying volatility monetization. And that's a big difference. How about the expenses and the structure of the fund? Well, the expense ratio is about 1.03%. Is that high? Well, compared to index ETFs, yes. But for actively managed option income ETFs, that is quite typical. You are paying for the active stock selection, the options execution, and the weekly distribution management. Assets under management are around 396 million. The fund is launched in April 2025, so it's still relatively new. We have not seen this fund through a full semiconductor bear cycle. That's something we have to respect. Since inception, performance have been strong, almost 90% since launch, year to date around 16%, 1 month about 5%. Now let's be fair, semiconductors have been strong. AI momentum is still powerful. When a sector is bullish, CHPY looks fantastic. But the real question is, what happens when semiconductors stall or decline? Because this is a cyclical industry, highly volatile, highly sentiment driven. If Nvidia corrects 20 to 30%, CHPY will feel it, and the weekly income will not magically prevent drawdowns. Now let's talk about the real risk. I always ask myself one question. If this drops 30%, will I panic? Because that's a real test. And here are the key risks. First, sector concentration. This is pure semiconductors. Second, it is capped upside. You won't capture the full rallies. Third, return of capital complexity. So the distributions can vary. Fourth, new fund risk. Well, it is less than a year, so this fund has short track record. And lastly, option strategy risk. It depends a lot on volatility environment. This is not a sleep well at night retirement core ETF. This is tactical. Now let me tell you how I personally treat this. CHPY is about 4.5% of my portfolio. That's intentional. High yield equals small allocation. I don't bet the house on 45% yield. If it performs, great. The income compounds. If semiconductors crash, it won't destroy my overall portfolio. Position sizing is everything. I'm not chasing yield blindly. I'm allocating strategically. Final thoughts? Is CHPY attractive? Yes, if you understand what you're buying. No, if you think 45% is free money. For me, so far, it has delivered solid income, positive capital gains, and a strong internal rate of return. But I treat it with respect. This is volatility turned into cash flow, and volatility cuts both ways. If you found this deep dive useful, let me know in the comments. Are you holding CHPY? Do you think this distribution rate is sustainable? And if you want more transparent portfolio breakdowns like this, subscribe. Because on this channel, we don't just chase yield, we dissect it. Alright, if you like this video, give it a thumbs up and subscribe to the channel. It will greatly help the channel grow. Thank you for watching, and I'll see you in the next one.